So, you get a mortgage, right? And it feels like you're just borrowing from one bank, one single place. But the real story is so much more interesting. The money for your home, it actually comes from this huge interconnected system. So you know what? Let's pull back the curtain and find out where that money really comes from. Okay, picture this. You found the property. It's perfect. But now you need, well, a lot of money. We're talking hundreds of thousands of dollars. So who are these people with the money? Where does it even come from? Let's follow the money trail. So it turns out the money basically flows down two main paths. First, you've got your direct lenders. These are the folks you'll actually meet, the ones who handle your application. But then behind them, you have the indirect lenders. Think of them as these massive behind-the-scenes pools of capital that are really feeding the whole system. We're going to start with the ones you actually know. All right, first up, let's talk about the group you're probably most familiar with, the direct lenders. These are the institutions whose names you see on buildings and websites when you go shopping for that loan. Okay, to really get how the modern market works, you gotta know this one key term, disintermediation. Sounds complicated, but it's not. It was this huge shift, right? Savers started realizing, hey, I can get better returns outside of my regular bank account. So they moved their money. This naturally drained the deposits from the banks, and it basically forced them to get deregulated and start competing in new ways. And that's how they ended up becoming such huge players in mortgage lending. So, player number one, the classic savings institutions. You might also know them as thrifts. Yeah, for the longest time, these were the go-to places for a home loan. They were really focused on single-family homes. And some of them are what you call mutual savings banks, which means they're actually owned by their members, kind of like a credit union. But honestly, over time, deregulation has made most of them look and act a lot like your typical commercial bank. Man, this industry has seen some serious regulatory whiplash over the decades. I mean, after the big savings and loan crisis back in the 80s, the government stepped in with a major reform act called FIRIA. Then, fast forward to the 2008 financial crisis, and boom, FDIC insurance gets bumped up to $250K to calm everyone down. It's just this constant cycle of crisis, then regulation, then crisis again. Okay, let's move on to the biggest players in the game, the real heavy hitters, commercial banks. And when I say heavy hitters, I mean it. Commercial banks are the single largest source of investment funds in the entire country. Now, historically, their main thing was business ventures and big construction loans. But remember that deregulation we talked about? Well, thanks to that, they've waded into the residential mortgage market in a massive way. All right, our third player is a little different. It's an institution built more on community, the credit union. Credit unions are pretty unique because they're member-owned. You might have one for employees of a big company or for people in a certain community. The idea is simple. Members pool their savings, and then other members can borrow from that pool. And yeah, they've gotten into the mortgage game since deregulation, but their overall slice of the market is still pretty small. Okay, hold on. Before we get to those giant, behind-the-scenes money pools, we need to take a quick detour. We've got to talk about two very important, and honestly often confused, specialists in this direct lending world. This is such a crucial distinction, so listen up. A mortgage banker, think of them like a chef. They use their own company's money to cook up your loan. They're funding it directly. On the other hand, a mortgage broker is more like a concierge. They don't have their own money. Their job is to shop around and connect you with a bunch of different lenders. So one makes the loan, the other finds the loan. See the difference? So you might be wondering, how do mortgage bankers do this without being a giant bank? Well, a huge part of their business model is creating something called a seasoned loan. Here's how it works. They give you the loan using their own funds, then they hold on to it for maybe 6 to 12 months. Why? To prove that you, the borrower, are reliable and make your payments on time. Once the loan is seasoned, they can sell it on the secondary market. And let me tell you, that business model pays off. For example, let's say you take out a $500,000 loan. A mortgage company might make around 2% in revenue from that. Do the math, that's a cool $10,000. Their whole business is built on originating these loans, seasoning them, and then selling them off over and over and over again. All right, so we've met all the frontline players you might actually talk to. Now it's time to really pull the curtain back and look at the massive, indirect sources of capital, the ones that are truly fueling this entire mortgage machine. And we are talking about enormous pools of money here. I mean, truly gigantic. And it primarily comes from two major sources, pension funds and life insurance companies. Just think about it for a second. It makes perfect sense. Pension funds need super safe long-term investments so they can pay for everyone's retirement, right? Well, what's safer than real estate? And life insurance companies? They're in the exact same boat. They collect billions and billions in premiums, and they need a stable place to park that cash for decades. Long-term real estate loans are pretty much a perfect fit for both of them. But hey, it's not just these giant institutions. The final piece of our puzzle involves private investors, and this can mean anything from large, organized groups all the way down to individuals. One of the most popular ways for regular people to get in on this is through something called a REIT. That's a real estate investment trust. It's basically a company that lets a whole bunch of people pool their money together to invest in a big portfolio of properties that generate income. Like office buildings, shopping malls, apartment complexes, and you can do it without having to actually buy the buildings yourself. And get this, sometimes the source of the money is the person selling you the house. I know, right? It's called carrying back a mortgage. A seller might agree to basically act as the bank for part of the purchase price, usually as a second mortgage. You tend to see this happen more often when money from the traditional lenders gets a little tight. Okay, so we've seen all the different players, from your local bank to these giant invisible pools of capital. Let's wrap this all up by looking at how they fit together in today's super fast-paced, tech-driven world. This chart here gives you a really great bird's-eye view of the whole primary market. You can see that commercial banks and these specialized mortgage companies are the really dominant forces. Savings institutions are still in the game, and then you have credit unions and other private lenders filling in the rest. It's a really diverse ecosystem with a lot of different sources all competing for your business. The internet has already completely transformed this landscape. You can get a loan from a company clear across the country with just a few clicks. And that brings us to a final, pretty fascinating question about the future. As this technology just keeps getting better and more integrated, will the lines between all these different lenders just blur completely? Could we be heading towards one single seamless digital marketplace for mortgages? Something to think about.